So what happens when a surprisingly strong economy, one that's just humming along on its own power, runs headfirst into a global trade war? Well, that is the exact story unfolding in Malaysia right now. Okay, let's dive into this.
Let's just start with a single really powerful number, 4.4%. In a world kind of full of economic uncertainty, that was Malaysia's GDP growth in the second quarter of 2025. I mean, that is a remarkably solid figure, matching the previous quarter and showing an economy with some real, genuine momentum. But the big question is, what's fueling this engine?
And the answer, as we're about to see, is that Malaysia's strength is really coming from the inside. While the global picture looks pretty shaky, the country's domestic economy has been, firing on all cylinders.
And if you break down that growth, it tells a fascinating story. Just look at this. Construction surged by a massive 11%. The services sector, which is really the backbone of the economy, grew at a super healthy 5.3%. This isn't a story about exports, it's a story about building, buying, and spending right at home. Really, only mining saw a big contraction.
This resilience isn't an accident. It's built on some very solid pillars. We're seeing robust household spending, strong private investment, and a fantastic labor market. With unemployment hitting a record low of around 3.1%, people are working, they're earning, and they're spending, and that's keeping the economy churning even as demand for its exports has weakened. But this strong domestic picture is about to face a major external test.
And here it is. This is that test, a storm brewing across the Pacific. Sweeping new U.S. tariffs are threatening to hit Malaysia right where it really counts.
19%. After weeks of negotiation that saw potential tariffs flying around as high as 25%, this is the number that landed. A brand new 19% tariff on most Malaysian exports to the United States. This is a huge deal for an economy that relies on trade, and wow, was it implemented shockingly fast.
Just look at how quickly this whole crisis unfolded. In April, the new tariff regime is announced. By July, Malaysia's central bank is already cutting interest rates just to brace for impact. And then, just a few weeks later, on August 8th, that 19% tariff becomes a reality. This isn't some distant threat, it's happening right now.
So, while the tariffs are broad, they don't hit all sectors equally. Not at all. The real squeeze is being felt in Malaysia's most vital, high-tech industry.
To really get the stakes here, you just need to know one number. $26.7 billion US dollars. That's how much electrical and electronics products Malaysia shipped to the US in 2024 alone. I mean, we're talking about a massive, globally significant industry that is now directly in the crosshairs.
Now here's a critical detail. The Malaysian government successfully negotiated a 0% tariff for raw semiconductor chips. That's a big win, right? Well, not exactly. As Wang Suhai from the Semiconductor Industry Association points out, the moment those tax-free chips are put into a finished product, like a phone or a laptop, boom, that product gets hit with the full tariff. It's a little detail that just perfectly illustrates the complexity of our modern supply chains.
And this isn't just about corporate profits or balance sheets. The potential human cost is staggering. The government itself has warned that as many as 100,000 jobs in the electronics sector could be at risk because of these tariffs. This is a direct threat to the livelihoods of thousands and thousands of Malaysians.
So faced with this storm, Malaysia isn't just standing by and watching. It's executing a multifaceted strategic response, and it's all designed to cushion the blow and navigate this turbulence.
The first step is just acknowledging reality. The central bank, Bank Negara, has already revised its growth forecast for the year downward. That initial optimism of 4.5 to 5.5% has been tempered to a more cautious 4.0 to 4.8%. This just shows they are taking the tariff threat very seriously.
And they're using their tools to fight back. In July, the central bank cut its key interest rate, the overnight policy rate, or OPR, for the first time in 5 years. Basically, by making it cheaper to borrow money, they're hoping to stimulate more domestic investment and spending to counteract that drag from weaker exports.
Strategy 1 is a classic move. Don't put all your eggs in one basket. Malaysia is aggressively pursuing new markets in places like Africa and the Middle East, while also strengthening its existing trade ties within ASEAN and with China through free trade agreements. They're trying to build a much more resilient trade network that's less dependent on any single partner. Makes sense, right?
The second strategy is to double down on what's already working, that super strong domestic economy. The government is rolling out measures like cash transfers, fuel price support, and even toll freezes to keep money in people's pockets and, well, keep them spending. They're essentially trying to reinforce those pillars of domestic strength we saw earlier. So, with all these moving parts, you've got a strong domestic core,
a major external threat, and a proactive government response, what does the path forward actually look like? Well, the consensus seems to be one of cautious optimism.
Okay, let's put a number on the potential damage. RHB Research estimates that these U.S. tariffs could shave up to 0.4 percentage points off GDP growth. Now, that might not sound like a huge number, but it's a significant hit. It shows just how impactful these trade policies can be. It's literally the difference between a good year and a great one.
But this snapshot here really gives us the bigger picture. Despite that tariff hit, growth is still projected to be a solid 4 to 4.8%. Inflation is staying moderate. Unemployment is incredibly low. And the currency, the ringgit, is actually forecast to strengthen. So ultimately, the economy's fundamentals appear strong enough to weather this storm, at least for now.
And all this really points to Malaysia's core approach here: cautious resilience. The trade minister has made it crystal clear they are not looking to escalate this into some tit-for-tat trade war. Instead, they're focused on pragmatism, hailing the negotiated reduction of the tariff from 25% down to 19% as a major diplomatic win. It's all about de-escalation and damage control.
Which really leaves us with this final, critical question. Malaysia has built this powerful domestic engine, but it's now being tested by forces far, far beyond its control. It really makes you wonder, in our deeply interconnected world, can any nation, no matter how resilient it is at home, truly insulate itself from the shockwaves of a global economic conflict? That's the question at the heart of Malaysia's story, and frankly, it's one a lot of other nations may soon be forced to answer.